Hey there, and welcome. You know when you look at a company's financial report and it just feels like you're trying to read a totally different language? Well, today we're going to be your translator. We're going to deconstruct the latest quarterly report from a company called Renaissance United Limited and really uncover the story that's hiding behind all those numbers.
So it all kicks off with this little sentence right here. Just before they drop their full report, the company put out what's called profit guidance. And really, it's a warning shot. It's a heads up to investors saying, hey, the news isn't going to be good. This one sentence tells us something's definitely gone wrong, and our job today is to play detective and figure out exactly what.
All right, so let's start this financial health checkup with the most obvious symptom, right? The bottom line. This is the number everyone looks for first. It's the one that tells you in black and white, or in this case red, how the company actually did. And here it is. Wow. The numbers tell a pretty stark story. So check this out. This time last year, Renaissance United actually turned a small profit, about $61,000. Now, fast forward to this quarter, and that has swung, dramatically, to a loss of $617,000. That's a negative turnaround of almost $700,000. So, what does this actually mean for the people who own the company, the shareholders?
Okay, so it all boils down to this number, a loss of 0.01 cents for every single share. Now, I know you're thinking, that sounds tiny, right? But here's the thing. When a company has over 6 billion shares, that tiny number suddenly represents a really significant shift from making money to, well, losing it. It's the difference between adding value for shareholders and watching it disappear.
Okay, so reporting a loss, that's the what. Now we've got to figure out the why. And to do that, we have to look past that big headline number and really dig into the company's core operations. Where did things actually go wrong? So to find out, we've got to look at the engines that are supposed to be powering this company's revenue.
So, turns out this company basically has two main engines driving its business. The huge one, the vast majority, at 78%, that's their gas distribution business over in China. The rest, that other 22%, comes from their electronics and trading business. So if we want to find the source of the loss, it makes sense we need to check on how both of these engines are running, right?
And, yep, right away we see a problem. The company's biggest business, that gas distribution segment, its revenue dropped by over $2 million. That's about a 15.6% drop. The report says it's mainly because of a decrease in natural gas sales. It's like they say, right? When your main engine starts to sputter, the whole car slows down.
But wait, it's not just their main business that's in trouble. The company's second engine is sputtering too, and it's actually getting hit even harder. The electronics part of the business, the one that supplies components to semiconductor makers, saw its revenue fall by a whopping 19%. And the reason? Pretty simple, weaker demand from its customers. So you've got both of the company's core businesses bringing in less cash.
So here's our diagnosis in a nutshell. When you put the downturn in both gas and electronics together, the company's total revenue from its main operations fell by 16.4%. At the end of the day, they just sold less stuff. And look, when your revenue falls that sharply and your costs don't drop by the same amount, a profit can turn into a loss really, really fast.
But look, a single bad quarter doesn't tell you the whole story. It's kind of like having a fever, It's a bad symptom for sure, but you really need that full body scan to understand the patient's underlying health. So now we're going to look at the company's balance sheet to get a much bigger picture of its overall financial stability.
And this is really the key question we need to answer now. Is this loss just a temporary setback, like a blip on the radar? Or is it a sign of a much more serious, maybe even chronic condition? Well, let's find out.
Okay, to figure this out, we need to get our heads around a pretty crucial term, net current liabilities. Let's break it down simply. It just means the company owes more money that's due in the next year than it has in cash or stuff it can quickly turn into cash. The easiest way to think about it, it's like owing more on your credit cards than you actually have in your checking account. And yeah, that's a pretty precarious position to be in.
And this is the scale of the challenge we're talking about for Renaissance United. They have a net current liability position of over $21 million. So yeah, this is not just some small cash crunch. This is a significant, heavy financial pressure that management has to deal with. And it's on top of all that falling revenue we just talked about.
All right, so we've diagnosed the illness and we've checked the patient's overall health. And yeah, the situation looks pretty serious. But now for the important part, what's the treatment plan? Because a good report doesn't just list all the problems, right? It's supposed to outline the solutions. So let's see what management says they're doing to try and turn this ship around.
So what's the plan to fix this whole thing? Well, the key here is that it looks like they're fighting back on multiple fronts at once. They're not just sitting around hoping things get better. No, they're actively implementing new gas pricing policies to try and protect their profits. They're diversifying with a totally new furniture distribution deal in the US, they're securing new rental income from a property in Malaysia, and they're streamlining, cutting costs by shutting down the parts of the business that aren't performing. It's a pretty active and aggressive plan for sure.
And what's cool is we can actually see how this plan breaks down across the company's different divisions. It's like every key part of the company has a role to play here. So, the gas division, they're fixing their pricing and hunting for new customers. The electronics division, they're working super closely with their clients on what future products are going to look like. And that US property arm is focused on generating new cash flow from that marketing deal while also trying to figure out how to develop its land. Okay, so we've got the diagnosis, falling revenue and mounting liabilities. And we've got the treatment plan, this multi-pronged strategy for recovery. That brings us to the final, and you could argue the most important part of our whole analysis, the prognosis. What happens next? You know, in the world of accounting, almost everything rests on this one big idea. It's called going concern. And it's just the basic assumption that a business will still be around tomorrow and the day after that to pay its bills and serve its customers. But when a company faces the kind of challenges we've just laid out, auditors and investors, they start to question that assumption. So this entire treatment plan we've been talking about, it's all designed to prove one thing, that they are, in fact, a going concern.
And so that leaves us with the ultimate question, doesn't it? This company is clearly navigating a pretty difficult storm. They have a plan, a real plan, but is it going to be enough? Will these new revenue streams kick in fast enough to offset the decline in their main businesses and help them manage that short-term debt? Well, only time will tell. The numbers in the next report will really tell the tale. But because we've deconstructed this one, we now know exactly what we should be looking for.